All right, everyone, welcome back to Money Show's Money, Metals, and Mining Virtual Expo. We have a fantastic panel coming up for you right now. So I'm going to turn it over to Brent Cook, economic geologist and senior advisor, Exploration Insights, and then the other gentlemen will kick off their sessions with a quick introduction. So Brent, take it away. It's all yours, sir.
Thank you, and welcome to all of you who are listening live this afternoon. Are going to pick this up later on the week at your convenience. What we're going to do here is I've got two people that I communicate with regularly on geology, investing matters, and we often get together for a drink or two as well when it's possible. We're going to go through sort of the big picture, how we see the mining and metals and junior exploration market now and into the future. Then I want to drill down into some very specifics as to how we look at investments, evaluate companies, projects, people, and make that investment decision or advise people who listen to us what we're actually buying and selling and that sort of thing. I guess I'll start off myself. I'm an economic geologist. I've been doing this for 35 years probably now. Worked in over 60 countries, lived in 3 or 4. I've done anything from grassroots exploration, digging holes in taking soil samples in Patagonia to bankable feasibilities studies and bank audits for ZCCM in Zambia and that sort of thing. So the whole gamut, if you will. I worked for Rick Rule at Global Resource Investments from 97 to about 2002 as their analyst, and started Exploration Insights in about 2008 it was, and met Joe Mazumdar here on a field trip in Nevada a couple of times, got to know him, and Joe took over and bought the letter back in, I think it was 2015 or 16, has been writing it ever since then. Joe, you want to tell us a bit about yourself?
Sure. I'm the only one here that hasn't worked for Rick Rule. So I don't, that's good enough. Yeah, so I'm a geologist as well as all the other attendees here or speakers. My background is mostly a little bit in Canada, but mostly Australia and South America doing geology for mostly big companies, gold, copper, mostly. And then I did an economics degree in Colorado, and then I started doing finance, trading, and market analysis for companies like Phelps Dodge and Phoenix, and then corporate development and planning for Newmont. And then I became an equity analyst for about 6 years before, as Brett said, I took over the Exploration Insights letter at the end of 2015. Thanks.
Thank you. Justin, how about yourself?
Yeah, obviously similar to everyone here, I call myself an economic geologist. I studied in Australia and did an MBA there as well, but like you guys, I joined Sprott in 2018. I'm the senior buy-side analyst as well as what they call me today. But before that, I spent the 2 decades before that out there in the industry, working for the biggest companies, helping to run junior companies, grassroots exploration through to mining, and everything in between, including economic studies. So trying to put together as much of a Renaissance mining background, which helps us today when it comes to evaluating companies at different stages and across the gamut of deposit styles and geographies.
All right, excellent. So you've got 3 guys here with a lot of experience in the metals industry, all good and bad. Okay, so what I'm going to do is start off with, seems to be a dichotomy between metal prices, and we'll talk specifically about precious metal prices, and the major companies that mine and produce these. And I'm going to throw up a slide right now from my screen. Let's see.
Yep, I see it.
Okay. let's go with this one. This is the one I really wanted. Can you see this?
Yep, I got it. You might want to scroll down just a bit.
All right, I did it wrong. Hang on. All right, let's try again. My apologies. Okay. Can we see this now?
Yeah, but I think that's a blank presentation, looks like.
Again, my apologies. This is the first time I've done this.
Just to prove it's live to everyone, right?
That's right. We practiced this already. You're going to have to get out of it and do it again because Zoom doesn't let you do it that way.
All right, let's do it again.
There, we got it.
You got it. Okay. My apologies, folks. This is the first. Usually I'm watching and not presenting. All right. So the discount was highlighted just today by Scotia Bank. And what's happening here is this little slide here shows that the discount to the current gold price for the major miners. And what we're seeing here is that these major miners are all trading at a significant discount to today's gold price. You can see Anglo, etc., Agnico, Newmont, with an average of 21% below what is typically the premium to discount going on there. And Tanya writes, the gold equities are attractive given their historically cheap valuation, trading at a 21% discount to bullion and a 4 to 6% free cash flow yields. That's amazing, actually. They've got growing cash flow and an increasing focus on shareholder returns with an average current dividend of about 2.9%. So what I want to go to is why it is that. And the second slide shows sort of how that looks. I'll just leave it as is. With the gold price here and the premium or discount here with the actual, what it should be right here. My question to you two is why do you think this is happening given what appears to be some really great valuations on these major mining companies? I'll start with Justin, if I will.
Sure. It's pretty brave asking me macro questions, but that's never stopped me before. You're right. Gold companies are profitable right now like no time I can think of in the last 25 years. As an industry, we're not just free cash flow positive, we're strongly free cash flow positive. I can't remember when that was the case last. And I think that's kind of the problem. We're winding up 2, maybe 3 quarters of positive results, really strong, profitable results in the Americas here. And as much as anything, I think what we really need to see is some consistency there. If you want to close that gap, because the profit comes from the rising gold price, you can see that it's going to need some leadership and it's going to need some consistency on behalf of the industry to maintain that margin. That means being focused when it comes to fighting against the cash creep, which is coming, not turning around and paying everyone exorbitant salaries or letting G&A blow out. It's a great time to reinvest back in the business, but as an industry, we need to do it in a sustainable and a disciplined way. If we can show that those margins aren't going to evaporate over the coming quarters, you'll see that valuation gap close. It's ours to cement or to lose again. Probably all of us on the call remember the last bull market, which sometimes got characterized as growth for growth's sake and overpaying for assets at the top of the market in some textbook examples of capital destruction and then failing to put the projects in. That's what we need to not do if you want to capitalize on these yields here.
So you're suggesting that the large generalist funds and investors, and I guess retail as well, are actually looking at the gold price and the profitability and free cash flow and don't believe it's sustainable?
Partly. I think that the generalists will pay more attention to us if, I mean, we've had 2 great quarters, you've had 4 great quarters. Awesome, do it again. What they're looking for is some consistency. You know, we haven't seen 3% dividend yields or 4 to 6% free cash flow yields for 20 years now. They see a business which is outperforming, but the question mark is, why should this time be different?
All right, so we won't talk about Tesla and their lack of free cash flow.
Outside my sphere of competence.
Joe, what do you make of all this?
I'm trying to work from that position than the opposite.
Fair enough. Joe?
Yeah, so I think, the idea is that what they've been trying to do, a lot of major companies with the mega mergers and that is to attract generalists, to distinguish themselves from the ETFs. From what I understand, there might be one ETF out there that pays a dividend, but most of them don't. And the 3 to 4% or whatever was quoted there in terms of the dividend yield now is great to attract these generalists. But the thing is, what these generalists look at is macro trends. I mean, everything Justin doesn't like, apparently. But the macro trend here is that real interest rates might be increasing. And so if real interest rates are trending upwards, then the trade is not gold. And so, because gold has this holding cost, and the holding cost might be increasing. And so if you're looking at that, the gold sector might not be what you're interested in, because you're thinking that the gold price is going to decline. So all valuations are not about past results, they're about future results. And so if you look into the future, the discount that they're applying of 20% suggests, from $1,800 is about $1,440. That's the gold price that they're thinking of. And most of the PEA scoping studies and feasibility studies that I see right now are still using 1,500, which is what banks are using. The big companies are still using 1,200, 1,250 in terms of reserves. Big companies right now are not attracting the normal resource investor because most of them lack growth. And the thing is right now is they've sort of dissed these people, the resource investor, by not showing growth anymore, to Justin's point, that some of them are scared of these M&A transactions that they went into last time. And they might, have another dilutive M&A transaction coming up, and they want to avoid that to keep the generalists in line. So they're playing this game right now between, how do I keep the generalists interested when they're thinking about these macro trends, and can I bring in back the resource investor by showing some kind of growth? And so right now, I think they're in a bit of, 1 foot in each sort of camp right now, but I'm not sure how they're going to play it. Because right now, like you said, balance sheet wise, free cash flow generations, dividends, everything looks great. But right now, going forward, I'm thinking, at least for the macro trend that these generalists follow, and for these more liquid major producers, their issue is probably the negative outlook that these people have on the gold price.
All right, so how do we play it? I mean, is there an investment thesis here that what should we and the people listening and our subscribers be doing right now? Joe.
Okay. What I would suggest is that, M&A has to happen, because these guys do lack pipelines, and that might not just be in gold. Maybe we're seeing a little bit more in nickel. We see a lack of projects in copper, and that's something that was playing out over the last year or so. Probably up till June was a upward trend in all commodities. The people looking at the sexy battery metals, anything that reduces greenhouse gas emissions, and gold and silver. Right now, I think there's still money to be had with respect to financing, potentially more so for the non-precious metal companies. But all of those sectors lack growth, and they have, I think M&A has to happen. And so in terms of what you're investing in, you should be looking at potentially to, get a little bit of downside protection of those companies that potentially might be takeout candidates.
All right. Do you have anything to add to that, Justin?
No, I think Joe's hit the nail on the head. The opportunity for us is that these guys will be reinvesting back into the business. All of metals mining is a business that isn't sustainable. Every day, every ton of ore you mine, it doesn't grow back again. So to maintain production, to maintain this profitability, then the producers we're talking about have to acquire assets of at least as good a quality as what they have now to stand still. And the opportunity for us is identifying them early and trying to be part of as early as we can and be part of that process.
Jeff Howard or Ed Bonner.
All right, excellent. That actually goes right into the next slide I wanted to talk about. Now, can you all see this one? Do I need to blow it up?
No, I can see it fine.
Okay, so this is another slide that I picked up off of a company's presentation. Development versus producing open pit deposits. And this is the all-in sustaining costs. And what it shows here in the kind of brownish color are deposits that are in production, their average reserve grade versus their all-in sustaining costs. And what immediately struck me about this is the blue circles. Those are projects that are not in production yet. They're the development stage. They've got some sort of technical feasibility study on them. And the results of these studies give what the all-in sustaining costs. And the amazing thing to me is that these undeveloped deposits all fall within the lowest quartile in terms of all-in sustaining costs. Yet these other deposits, which have been, in production for years, have been optimized. They've worked out the hurdles, the details, the problems. They're all more costly to mine. I mean, you can see where I'm leading, but Justin, what do you make of this? What's really going on here in terms of this chart?
Well, to be a little uncharitable, the simple conclusion is that generally speaking, the studies are hopelessly optimistic. In the worst case, perhaps, and not necessarily any of these examples, but a lot of people that do the studies don't necessarily have an expectation that they'll be the ones operating the project when it becomes a mine. So over-promising now on an all-in sustaining cost leads to a lower cost of capital, a higher share price, and any downside is out into the future. To expand on your observation, I remember a 2019 research piece that looked at about 40 different feasibility studies that had been put into production over the last decade. The average overrun on capital expenditure was 60% from the feasibility study. The schedules were similarly blown out. The devil's always in the detail, but it depends how far down the rabbit hole you want to go. It's pretty easy on these when you're doing the study, everyone assumes they'll have top quartile productivity from their mining fleet. Nobody wants to think their mine will be only average, or even worse, below average. Half of them will be, but at the same time you're assuming that productivity, often you're also assuming below average G&A, you're assuming standard or minimum maintenance on the equipment, average salaries. Those two don't go hand in hand. Obviously, not all investors go to that level of granularity, so it's helpful to have a tame broker or an analyst or an industry specialist you can talk to, because some of them may genuinely be that good. There is projects out there which other companies will want to have, and as they continue to de-risk them, the bigger guys will hopefully acquire them and pay for it, which I guess is our plug for Sprott and Exploration Insights, for having, you know, access to somebody who can help go through these and try to find the quality amongst the crowd.
Well done, Justin. I'll owe you a beer. Joe, do you have anything to add to this? What do you when you look at this, what do you see? What comes to mind?
Well, yeah, I would call it, you know, the thing is that my problem with a lot of these all-in sustaining costs is that I don't really look at them. I know that it's an industry standard now and people like to put it in, but it seems like a very crowding exercise where everybody wants to be elite when they go through, you know, get your flight. They always want to be in group 1, but somebody's got to be in group 4, and there might only be 2 people in group 4, but the reality is, you know, there's a lot more people that should be in group 4, but everybody wants to be in the lower quartile, and they push that study to make it look like they are in the lower quartile, even though they're technically not. And the amount of engineering in a lot of these feasibilities is almost the minimum that's required to be called a feasibility study. A lot of the quotes that are done might be 2 years old, depending on the engineering company you use. You know, so some of these engineering companies, the independence of them is a bit of questionable, you know, because, you know, you'll take the guy that'll get you the lower half of the cost curve. You'll take the guy that'll get you the 20% IRR. If some guy shows you that the project isn't economic, much like what happened with International Tower Hill and Livengood, that was the only company that showed me a feasibility study that wasn't feasible. And they never built the project. I mean, you should do that. And if it doesn't turn out, you say, okay, I'll leave it in the ground and not produce a study that's obviously something you wouldn't build yourself because you know it's not true. Each one of these projects has its own issues. Marginal projects tend to have more risk that they'll blow out, you know, not necessarily in the capital, but probably in the operating costs. The big milling projects that are remote, definitely, you know, when people say plus or minus 30% on the capital, it's usually plus 40. It's never negative. It's very rare that an engineering company or a company can bring in a project on time and on budget. There's been very few examples of that. But what we're sort of saying when we look at these studies, okay, you can do this. There's a lot of less of saying, okay, I don't think you can do this. What happens if the grade's not there? And more important than the all-in sustaining costs from somebody that's looking to invest in a junior developer and they want to build it themselves is working capital. Because when we look at it, they spend all this capital to build it. Then they go, oh, hey, I reached commercial production. Great. And then that 6 gram or 8 gram deposit ends up being a 2 gram deposit. And now you're paying back the debt, you know, maybe a high yield debt of 10 or 12%, and suddenly you've run out of cash. And nobody wants to give you money, especially the equity investor, when everybody sees you have to come back to the market. And so that's really, for me, when you look at these development projects, another big issue. Like, do I give you money now or do I give you money later? Is this really the last dollar in? And the all-in sustaining cost is not usually the best measure of knowing which project's going to make it and which project's not going to make it.
So you wrote a really good article. You put it on our website, I think, and if you didn't, I'm sure you can mail it out to anyone interested, that looked at financing options and how companies finance their development of their projects and what that can tell you about the project itself. Can you just briefly go through that?
Sure. So if you can't do all the due diligence, and especially if you're not a technical person and you're not going to read the 1,000-page feasibility study, then the thing is, like, learn the project vicariously by the people that give the money. Ignore the equity guys, because a lot of them won't be doing the due diligence, but you could look at the equity side and say how much of it is coming from equity, and then look, did they have to issue it at a big discount? Did they have to issue a warrant? Was it a full warrant? Was it 5 years? Was it 2 years? The more on the equity side that they had to issue a bigger discount, a longer term warrant, then you know that there's something wrong with the project because the demand wasn't there. If they can issue equity at no warrant, at almost at market, that says the project's quality. Then on the other side, the other forms of financing, could they get straight debt? If you talk to any CEO, what they would prefer is to get straight debt. And what does that mean? Something that might be a 5 to 6% plus LIBOR that they can get. And for you as an investor, you know that a bank's due diligence is probably going to be better than a private equity due diligence, than maybe even a streaming due diligence. The last thing anybody ever wants to do as a CEO is put a stream on their main product. So once you see that, once you see a stream on the main product, then you know there's something wrong with the project, because nobody wants to do that. No CEO in his right mind would ever say, you know, my goal in life is to get a stream on my main product. Because then the retail guy is going to look at it and go, well, if I want exposure to this, I don't have exposure. The streamer does. I don't. So when you look at that, you can read the tea leaves of the financing and then find out from that vicariously, basically use that as a proxy to say, well, maybe there's something I should dig into a little bit more on this, you know, lower quartile all-in sustaining cost of $600. It appears nobody else believes it.
Right. And when you're talking about a stream, I think it's important to point out that, you know, say you've got a big copper silver deposit with some base metal credits, a stream on the base metals, for instance, that
absolutely. Like when I say main product, it's one of the things that makes the revenue, big part of the revenue. Anything below 10% of the revenue is a byproduct. And that's really where streaming came from. The whole idea for streaming win-win situation is that if I produce like a nickel project and I've got some PGMs, platinum group metals, and I stream that, nobody cares about that in terms of they're looking for me for nickel exposure, that is absolutely perfectly fine. There's no issue with that. The big issue is that if they have to or are forced to issue it on the main product.
Perfect. All right. Anything to add to that, Justin?
No, I think Joe's hit most of the points. I mean, what you really want to see is a competitive process that suggests your project is in demand, and the debt and the streamers have access to more data than, you know, average investors. They sign confidentiality agreements and go behind a wall and go into the data room. They're going to understand the risks to a much greater degree, and their interests aren't perfectly aligned. I mean, debt providers want to get paid back. They don't care about shareholders. Streamers are long the project. They're right there with you, but they're hanging around forever. They get all the upside to commodity prices and additional exploration. But where you see lots of groups wanting to participate, you know, multiple offers and lots of options for the company, that suggests a robust project that's in demand. You know, on the equity side, the other thing you can look at is who's writing checks at the key point along the way. If you've got a mining magnate or a large institutional mining company who's happy to pay their pro rata share of ownership all the way through, that's a pretty good endorsement too.
All right, great. Well, I might as well just go to my last slide here, which gets down to how I guess retail investors, how can they play this discovery curve, and more specifically, I guess, what sorts of things do you two look at in company news releases as a company's advancing from, you know, the very early stage exploration into the drilling stage and resource definition stage? What, I guess, red flags or specific things do you look at to quickly screen good or bad news and know when to buy or sell a company? I'll go straight to you, Justin.
I was hoping we'd go straight to you because I'm not sure I understand the question. But
what do you look for when a news release comes across your desk? What what tells you this is legitimate? I need to investigate it more, or this isn't something I want.
Yeah, okay. You know, at the very early stage of that graph, anybody who's been listening to you and Joe for a while will already be quite experienced in breaking down drill results. Though you probably talked to everybody about things like true width, about understanding smearing and how to think about those results. Other things to be aware of at early stages is pulling apart whenever you see the word equivalent after a metal of interest. Having a think about not just what other elements have been jammed into the equivalent, but what's the likelihood you can make $1 trying to recover these. As you get further down the line, there's a bunch of other flags, and you know, the question you've got, we could do an hour on just here, right?
Yeah, I think you're right. I'm thinking about it myself. Like, Jesus, there's a lot of things involved in geology, the continuity, the stabilization, nugget, etc., like that. But what?
Well, that's the actually
quick streams.
No, that's a great segue. That's where I was going to go with this. I mean, the drill holes in themselves are one thing, but the one thing I'd point out to expound on people who are already used to that, look at the continuity. It's just as important as understanding the grade. There should be a section or there should be a plan somewhere in the press release. If there's not, that's a yellow flag. But does the ore thickness change wildly from drill hole to drill hole? Do you have bonanza grades that disappear above and below that? You can build quite a large resource on very discontinuous ore bodies if you try hard enough. It's much, much harder to turn them into ore later.
Joe?
I was just listening.
Taking notes.
Yeah,
Good.
yeah, good. I mean, again, there's two places to go in terms of the early exploration, and that's obviously the high risk, high return. But really, the risk you want to take is on the drill bit. You don't want to take the risk on the management. You don't want to take the risk on, let's say, social license to operate. You don't want to take a risk on the metallurgy. You want to take a risk on, you know, hey, I just gave you money. You're going to drill 10,000 or 5,000 meters to prove this thing up. And then my thesis is that, you know, maybe you can find an open pit heap leach amenable deposit, you know, and I'm thinking maybe it's 0.5, 0.8 grams. Okay, that's in my head what success looks like. Here's the money, you drill it, then you get the results, and then I have to decide, is it looking like that? Or is it not looking like that anymore? And so when I always talk to a company, you know, the easiest filter first is management. So if you've seen a lot of this stuff, if you see the management team, you go, you know, the hardest due diligence is going through the technical reports, looking at and you know, trying to look at everything. And so if you can just get to the management and say, well, I'm not going to touch that, that saves you about 6 hours of time. And then you could just move on to the next one. And so when you do decide to do all the due diligence, you want to not go do all of that and then find out, oh my God, look at the management team or look at the share structure. And that's another big point, is that before you do anything, do check the share structure, because remember, you're not buying the asset, you're buying the equity. So, you know, bad management could still ruin a great asset by diluting the hell out of it. And so as retail investors, we're buying a share of the company. We're not buying a piece of the project. So we're not the streamer. We're not the royalty company. We're not a big strategic investor. We're just buying a share. And so all that due diligence, all that time you spend, focus it on the ones that pass those initial hurdles right away. So you don't have to go looking at the management team later. And I would say that, you know, there's two opportunities: the high risk, high reward on the drill bit exploration story, and then the development story that's been orphaned. Like, do you take this development story? Do you believe that they can build it, or are you waiting for a takeout? Those are two different things. So I usually, if somebody says, oh, I've got a lot of people that might want my project and I think I've got a lot of bids, but if they don't want it, I'll build it. Then you know that there's something wrong. You think, well, can you build it? And then wait for, oh, here's my COO. He spent all this time with this big company, but he was just taken out of retirement. All he's sort of doing is supervising your technical report. He doesn't want to build a project. So that sort of stuff you got to understand. Like they might tell you whatever, they promise you the moon. But the thing is that can they actually deliver? And technically, it's hard to say once you got more information. But again, management is key in all of these potential spots that you're looking at in that curve.
Yeah, those are some good screens to get started. Management, share structure. All too often, we see a company's market cap gradually increase, but the share price never goes anywhere. In fact, it usually goes down as they continue financing, which tells you again, there's probably a problem with this project. And taking into consideration what the market's doing. I mean, when the market sucks, it's hard to get anything moving unless you've got a real significant discovery going. We've got officially about 5 minutes left. Are there any questions on the chat side of things?
Yeah, gentlemen, thank you so much. We had a viewer wondering, they had purchased Kirkland Lake and they had heard it was one of the best gold mining stocks, and they were wondering if you agreed with that.
Kirkland Lake.
Fosterville detour.
Yeah. I've got no comment on that. I'd say I'm neutral on it. It's not something I spend a lot of time in, except understanding the Swan Zone and how it relates to other projects around.
I could take a stab and then I'll leave it to Justin. But I visited the Fosterville mine and it is a spectacular mine. But the ability of that mine of continuing, and we talked about all-in sustaining costs. That is one of the legitimately lowest all-in sustaining cost mines in the world. But that kind of quality is not eternal. It's going to fade. And so hence the reason Kirkland bought Detour. And so you're changing from a company who's generating free cash flow from an asset that can make money in any gold price to one that's probably a little bit more marginal, a lot more marginal, and is probably more levered to the gold price. So it almost like it's the same company, but it's really changing its asset base and changing what the gold price means to their ability to generate free cash flow. So that would be my own comment. I don't own Kirkland Lake, but yeah, that would be my comment on it.
I have to think that what it tells you about Kirkland and their Fosterville deposit, which, as you point out, was one of the lowest cost out there. They certainly looked the world over for another low cost project they could acquire and didn't find one, ended up buying Detour. Again, that goes to the point earlier that we've got all these lowest quartile production companies that are not being acquired by the guys that are out there looking at and hard at the detail. So bottom line, a very high grade, high margin deposits are hard to come by.
But just before we give this to Justin, I know he's itching to get into this, but I would just say that a lot of the companies that I've seen that have very high quality projects, it's almost a curse, because to grow and to look at something that's not dilutive is next to impossible, because you'll never find something almost that's better than your project. And that was part of when Bisha was a good mine, that was part of a problem for Nevison. And I think that same problem was for Kirkland. Like, how do I do better than this?
Justin.
It was such a good spot to leave it, saying high grade, high margin deposits are very hard to come by. That was the full stop. All right. Do we have any other questions on the chat side?
All right, we have a few minutes here. We've got another viewer. They kind of said a gold exploration 101 question for you. How strong is the correlation between high grab samples or surface outcrops and the economic deposit below ground? In other words, how does a surface high grade sampling give a false positive for a deposit below? How often?
I can take that since I've spent so many years stumbling around the hills picking up rocks. A surface sample, there's a number of ways to take one. A grab sample is basically one of the first samples you take when you're onto a new project and you're just trying to get a sense of, is there gold here? And what do the rocks look like that carry the gold or copper, whatever you're looking for? And they're indicative that you're into some sort of mineralized system, but in general, they've got very little to do with what you're actually going to find in terms of the deposit. That's been my experience. And soil samples as well. You take soil samples, you've got an anomaly, then you go back in and you're trying to find where that anomaly really is, what the structure is, and you know the geologic system, if it's a porphyry or a high-grade vein or whatever it might be, and you work from there. So they're very useful in terms of the initial exploration, but it's a geological anomaly. There's millions of those, but it takes a very unique set of geologic events to form an economic deposit, and that's why they're so rare. Anyone else?
Justin?
I think you nailed it, Brent. At the end of the day, if we're talking about rock chips and things like that, the correlation is correlation isn't the word you want. What you've got is a binary sort of outcomes. Yes, there's something here to keep looking at, or no, there's not. And that's where it ends. After that, there's a bunch of other stuff that happens that becomes more and more representative and costs more and more dollars and gets you closer and closer to an answer. But those early stage rock chips, you're looking for a red light, green light decision point, and there's no relationship to what happens after that, other than yes, it's worth more time.
Yeah, I mean, I've bought a number of stocks based on just even soil samples or rock chip samples in the context of the geologic setting, and done quite well on it. But it's a long way between the soil sample and defining a deposit. But if that's really the stage I like to get in, if possible, if the geochemistry, geology, geologic setting all fits, and you're only dealing with a market cap of something under 10, 20 million, it's worth a shot.
A very, very detailed soil grid can be a wonderful tool, and it tells you a lot about what's going on, but that's measuring something else from, grab samples.
Mm-hmm.
I just want to add one thing is that, when I did work in exploration, and like you guys, it's layers of information. So the rock chips, like Brent said, if you're just doing prospecting, people take grab samples, and they're on purpose high grading those. And just because you're in a remote area, you spent a lot of money to get there. And the thing is, like, what is the best thing this prospect has? This is the best looking stuff I saw. I'm going to take samples of that. And if this doesn't have anything, I'm dropping it, because this is the best stuff I've seen here. And if it doesn't have anything, I'm out of here. But if you do find something and it's wow, I've got like 5 grams, where'd that come from? Over here. Maybe there's more spots. And then you put in your soils. Then you put in your geophysics. Then you do all these things that sort of say, you don't just use one point, you use a whole bunch of layers of data that you can. Be wary of the guy that only has a geophysical target. Because I've worked in geophysics and I've taken surveys, and I can make anomalies for you. It's really easy. But you need all that other, data sets, the soils, the rock chips, the structure, the geology, just saying, okay, this is where I think it should be. Do the soils sort of back that up? Do the rock chips back that up? So every one of these different deposits requires a different look. Rock chip sampling, soils, that sort of stuff is basic. How you apply geophysics depends on the type of deposit. And whether you say, oh, there's a definite one-to-one correlation between this and an economic deposit, I wouldn't say that exists. But I would say, like, I've been fooled before, with the Quale project with Evram. They did a trench sampling, but it appears that was oxidized, and then it sort of was in an enrichment zone, and below that there wasn't anything. But would I say, hey, I would never have drilled that? No, I would never have said that. They'd had 3 or 4 trenches that had 100 meters of 2 or 3 grams. I would always drill it. I'd never walk away from something like that. But there's enough there to justify the drill program. That's when I would have said, okay, I'll put my money in. It didn't work out. It didn't work out.
Yeah, good point. I'll add one more thing on the geophysics. Basically, geophysics is just measuring differences in rock type. And you do just geophysical survey, you're guaranteed an anomaly, which is only telling you there's a change in rock type characteristics. So I'm very cautious on geophysics on its own. Do we have any other questions there?
Yeah, one last question to close us out, gentlemen. So if you all want to take it, or one of you, feel free. There, a few viewers were wondering, what are some spectacular products or projects in the industry that you're keeping your eye on right now? And they're also wondering how to get their children interested in geology.
Oh, wow.
Go ahead, Joe.
I haven't bothered getting my children interested in geology. Just let them get to it themselves. With respect to spectacular projects out there, I mean, even in this day and age where people are sort of down on the sector, you can still, get a company like Chalice with a big, huge land package that they're looking for nickel in West Australia. That's got a $1 billion plus, market cap. So, you can see a company get there. I mean, and so even in this sector where everything looks negative and the sentiment might be negative, a decent drill result, somebody with a giant anomaly that they've drill tested and it turns out to be correct, there's still a lot of lift that you can get right now in the current market. Things like Chalice, Rupert Resources in Finland, they look like they're onto something. There's a lot of these sort of companies, but do you want to buy that 700, 800 million junior company with no resource, or do you want to go back to the 10 to $15 million company and maybe they could come up with something and make the proverbial 10 bagger? I right now would prefer to go back downstream or upstream, sorry, and look for the one that could potentially be the next one of those.
So give us one out of your portfolio, Joe.
Well, I mean, right now, one of the ones that I'm looking at that, it's like a prospect exploration company is Radius Gold. They did well drilling this project Amalia with Pan American, but Pan American owns that project now. Radius is just on along for the ride, but Pan American is slowly earning it and taking it out. They've got another project with this company called Volcanic Gold Mines, and they're drilling this project called Holly Banderas in Guatemala. Guatemala is not everybody's flavor, obviously, but they just put out some more drill results recently that look very interesting to me. There's a big regional structure coming through there and a bunch of cross structures. I don't really know what they have yet, but so far the drilling looks pretty good. So that's what I'm looking out for.
Great. I'd say Radius is probably the most recent company I've bought, which basically because I've been to their projects in Guatemala that Volcanic Gold is drilling. I know Justin can't recommend or talk about specific stocks. So I guess we'll wrap this up. Joe, since you're on my screen, tell the folks how to get hold of you and what you do.
Right. What I do. I write, edit, publish this weekly publication called Exploration Insights about what I'm buying, selling in the junior mining sector and major mining themes and that. It's called Exploration Insights, explorationinsights.com. There's a lot of free site stuff on the website. And we also run a podcast, me and Paul Harris, that we put out. It's on YouTube. It's called Another Mining Podcast. And we've done interviews with the Lundin family. And we also talk about major themes. So there's a lot of free stuff there. And if you want to subscribe, there's a big red button that allows you to do that.
Justin?
Yeah, as you say, Sprott is probably the biggest and best leading precious metal focused place for resource investors you can find in North America. If you have an interest in that kind of thing, you absolutely should be looking into Sprott. And we have plenty of full service brokerage available, and as part of that, you'll get access to all of our research, which is done in-house, and specialists, not just in all facets of the mining business, from macro through to individual companies.
All right, well, great. And I work with Joe, and I advise a few funds and such. I can be reached via Exploration Insights website as well. And I'll vouch for these other two guys as being legit. And thank you all for joining us. I hope it was worthwhile.